Hi there, it is Alvin from Dr. Wealth. Today I'm going to talk about Apple being the very first $3 trillion company in the world. So it broke the record on the last day of June 2023. So it closed above that $3 trillion market cap. And Apple is also the very first company to hit the first $1 trillion. That was in 2018. And in 2020, it hit its second trillion. So now we're talking about 3 trillion. And that's a lot of zero. That's like 12 zeros at the back. And even as we talk about Apple achieving that $3 trillion market cap, I believe that it is just a matter of time we will hit that $4 trillion mark. In fact, it gets easier. So from 3 trillion to 4 trillion, it will take about a 31% gain from where it is now at the time of recording, and it is not something that is unachievable. Given enough time, maybe 1 or 2 years later, Apple may hit that $4 trillion mark. So it gets easier because from 1 trillion to 2 trillion, it takes about 100% gain to hit that second trillion mark, and then from 2 trillion to 3 trillion, it will take about 50% gain, and now we are talking about just 31% gain. So you can see that, so the amount of gain that actually required gets smaller and smaller due to the bigger base that the market cap has already had. And Apple is not the only $1 trillion company, right? So there are quite a handful of them, and we want to go through one by one. So in the next category, these are the $2 trillion companies. We have Microsoft as well as Aramco, which is a Saudi Arabia oil and gas company. So for Microsoft, it is about $2.5 trillion, and hitting 3 trillion only takes about another 18%. So it is very likely that maybe, even possible that we can see it in this year. Microsoft may hit that $3 trillion mark if the market continues to be very bullish. And for Saudi Aramco, it requires about 44% to hit that $3 trillion mark, which I think in this case might be difficult to see this year because Aramco's performance is very tied to the performance of oil prices. And based on the outlook, the oil prices are not looking very good, and it seems like the prices are going down more than it's going up. Aramco is not likely to hit the next trillion this year. And in the first $1 trillion club, the $1 trillion club, we have Alphabet, Amazon, as well as the newest member, Nvidia. Due to the AI hype, Nvidia share prices have gone up so much. Yes, entered the $1 trillion club. And for Alphabet, it's the closest to the $2 trillion mark. With another 31% gain, it will hit that level. And for Amazon, it's another 50%. And for Nvidia, it's a lot further, it's another 92%. So we'll see how crazy the AI hype can be to push up the Nvidia price to 2 trillion. Personally, I don't think it's very likely. Currently, it's a lot more overvalued compared to the rest of the $1 trillion companies. And there are also companies that are sub-$1 trillion. So for example, like Tesla, Berkshire Hathaway, as well as Meta Platforms. So Tesla and Meta Platforms were previously in the $1 trillion club. Because of the negative news that impacted both stocks, they have fallen a lot and they have recovered part of it, and now they're back on track to hit their $1 trillion mark again. So Tesla is the closest with $830 billion. With another 20%, it will hit its first $1 trillion mark. And for Berkshire, it will be another 34%, and Meta close by is about another 36% gain to hit that $1 trillion mark. So I would say Berkshire is the special one among the rest because it is not really a tech stocks. Yes, it does have a lot of Apple investments, but it also owns a lot of those traditional sectors, oil and gas, railroads, a lot of those sectors that a lot of investors probably don't find sexy anymore. And Berkshire is a lot more diversified, and to hit that level, the $1 trillion mark as an investing holding company, I think that is a remarkable feat by itself. So really kudos to Warren Buffett, and hopefully we can see Berkshire Hathaway hit $1 trillion mark while he's still around. And you might probably heard of the term called Fang, F-A-N-G, right? It's to denote the big tech stocks. And there is this Fang Plus index where it consists of just 10 stocks, okay, 10 tech stocks that a lot of investors are interested in. You can see 5 of them are actually in the $1 trillion club. We have Apple, Amazon, Microsoft, Alphabet, Nvidia, and there are 2 that are almost in $1 trillion club, which is Meta and Tesla. So Snowflake and AMD seems like a little bit out of place here, okay? And of course, this index will change its component as time goes by. But here are the 10 stocks, and this is one simple index where you can get exposure to the $1 trillion club. Okay, because instead of buying the individual stocks, you can just buy the entire index. But of course, we can't really buy the index per se. We need a financial product that tracks the index, okay, which I will explain to you what that investment is going to be later. But first, let's look at the performance of this Fang Plus index. So this is a comparison between a period of 2014 to 2023. And these are the annual returns, and we're comparing three indices, okay, NYSE Fang Plus, which is the index that we are focusing on, and then there's the well-known Nasdaq 100, which is tech focused as well, but more diversified, and then we have S&P 500, which is a diversified index. And you can see the annual return in the past 10 years, the Fang Plus has returned 26% per year, while Nasdaq 100, which is already impressive at 17% per year, still dwarf the returns of Fang Plus, and S&P 500 is also up 11% per year. So all these in general are very fantastic returns, right? Saying we can actually zoom in and attribute majority of the performances to the big tech stocks or the trillion-dollar club stocks that we have talked about so far. Because even S&P 500 or even Nasdaq 100, they consist of the same trillion-dollar club stocks, and they are very big component in the index itself. So these Fang Plus stocks are actually the ones that are driving the performance of Nasdaq 100 and S&P 500. So might as well investors buy the Fang Plus index, okay, since it is the performance driver anyway, and you can edge out that higher return just by focusing on the biggest tech companies that are heavily traded as well. Before I review to you the investment that can help you buy the entire Fang Plus index, I have the following announcement for you. Today's episode is brought to you by FinBite Insights. So this FinBite Insight is started by Alvin, and that's me. And each day I will articulate my thoughts about the financial markets. Just by reading it in less than 3 minutes, you will be able to get a very good understanding about what's going on, what's the most important thing that you need to know about the financial markets for that day, and how do you interpret it so that you can make better investment decision out of it. So do remember to go to finbiteinsights.substack.com and you can subscribe it for free and start enjoying the daily insights that I'll deliver it to your inbox. Okay, welcome back, and this is the instrument that I'm talking about, Microsectors Fang Plus ETN. Okay, so take note, it's not an ETF, it is an ETN. I'll explain in the next slide what is an ETN and what are the differences between ETN and ETF. So the ticker is FNGS, and the issuer is Bank of Montreal, and the maturity date is January 8, 2038. So you might be wondering, why is there a maturity date? Okay, I'll explain soon. Expense ratio of 0.58%, and the fund size is over $100 million. So what's an ETN? So ETN is itself a debt instrument, and the N in the ETN stands for a note. Okay, so note itself is a debt instrument. So it's like IOU. And the issuer is the borrower. So just now I mentioned that this Bank of Montreal is the issuer. So the bank is actually borrowing money from you if you invest in the ETN. And unlike normal bonds, this ETN does not pay any interest, okay, but it doesn't mean that you must hold your investment until the maturity date, okay, which is quite far, 2038. You can sell the EDM in that sense you are redeeming the note, and in return, the bank will calculate whatever the market value of your investment is, less the fees, and they will return the money to you. Okay, so it's not necessary that you must hold until maturity. Just like bonds that you buy, you can sell before the maturity date. Another thing to know is also that investors have no ownership of the underlying securities. Okay, so an ETN is purely a debt instrument. If you ask me, is there a big difference between ETN and ETF? In terms of performance, I don't think that is a big difference, right? Because they will naturally have their own tracking error, but they will try to mimic the index performance as much as possible. So whether it's ETN or ETF, it doesn't really matter. But in terms of the risk, ETN is seen as more risky than the ETF because ETN has a default risk embedded in it, while ETF doesn't. Okay, so what is this default risk? That means if let's say this Bank of Montreal go bust, it might not be able to return the money to you, okay, because they borrowed the money from you. ETF investment dollars are segregated from the issuer. So in the case that where the issuer go bankrupt, you still can get access to your funds. Okay, so that is the key between ETF and ETN. But other than that, I don't think it's a showstopper, okay, because even for Bank of Montreal, it's one of the biggest Canadian banks, and in terms of credit rating, it's also investment grade, so relatively it's quite a stable bank, so it's likely that they will honor whatever they owe. And this is a quick comparison between the various US index ETFs or ETN, because for most investors who want to buy US, they will think about whether is it S&P 500 or is it QQQ, which is tracking the Nasdaq 100. Now we have one more alternative, which is the Fang Plus. Okay, so I just want to give you the comparison quickly. And Fang Plus, we know that there are only 10 stocks. Okay, so Nasdaq 100 has more, 100 stocks, and S&P 500 of course is the most diversified with 500 stocks. Okay, so we can see that for Fang Plus is definitely more concentrated, and it's only in one sector, which is tech only. Okay, there isn't any other oil and gas sector, consumer staples don't have. All right, it's purely tech. And for Nasdaq 100, it has other sectors, but naturally it is geared more towards the tech sector. I think it's about 50%, right, in tech sector. And while S&P 500 is very diversified, it has like 10, 11, or even 12 sectors exposure, right? So if you want to go for a more diversified kind of portfolio, definitely S&P 500 is the more relevant one. But let's say you really believe in the big tech and really believe that they are going to add more value to the economy, they are going to be the big players, continue to be the big players in the world, and naturally the Fang Plus exposure makes a lot more sense. Okay, and in terms of expense ratio, you can see that S&P is the cheapest with 0.09%. Nasdaq 100 is about 0.2%, and Fang Plus is the most expensive at 0.58%. So some people might be thinking, right, oh, why would I want to pay 0.58% to buy just 10 stocks, right? And I understand if let's say it's Nasdaq 100 or S&P 500, because there are so many stocks, hundreds of them, right? You wouldn't want to buy one by one. But 10 stocks is not difficult if you want to buy one by one. Why would I still have to pay such a high fee to get access to the 10 stocks? It is true, right? So if you are buying the individual stocks, you can go ahead and do that. But that said, there's still a fund size over $100 million, which means that there are investors who don't mind paying the fee just to get the convenience, right, to buy that 10 stocks, and any index changes, they will take care of it. So it's suitable for certain investors who don't want to think so much and don't want to manage the portfolio, so we just buy the top 10 tech stocks and let the index do the adjusting. And the CAGR, which is the annual return, has been quite good since the inception, which was about 3 years ago, and it is 29% per year, right, as we have saw in the back test as well over a longer span of time. It has also returned 20%. And Nasdaq 100 is at 18% per year, and S&P 500 at 11% per year for the past 3 years. One thing to note is that there is a price to pay for a concentrated portfolio. You can see that the volatility is higher as measured by the standard deviation, right? So the number higher means that the counter is more volatile. You will experience a lot more price swings as compared to the one with a lower standard deviation. So for Fang Plus is 32%, for Nasdaq is 24%, and S&P is 20%. And drawdown means that you will suffer sort of like a consecutive drop in your portfolio value or the ETF ETN value. And for Fang Plus, it experienced a very terrible 43% decline, while Nasdaq 100 was down 33% and S&P 500 was down 18%. So large part of this loss was made or generated in 2022 when the market was not doing well. So you can see when the market drops, Fang Plus will drop more. Okay, when the market goes up very bullish, Fang Plus will go up more. So it is a double-edged sword, right? You cannot get higher returns with lower risk. Usually you have to assume more of this volatility if you want higher returns. So that is how you size up these three, right? So each has a different purpose. Okay, so let's say you find that Fang Plus is too concentrated, you still believe in tech, then Nasdaq 100 or QQQ makes a lot more sense, right? And of course, just now we talked about if you are very diversified, you don't want to be just in one sector, then S&P 500 will make more sense. So Fang Plus is mostly for investors who are very clear. I want to only get exposure to the big tech. I want to invest in the trillion-dollar companies. So hopefully this can give you a better idea what is more suitable for your context. So in summary, I believe that more stocks will hit trillion-dollar status. It is going to be more like a norm, right? It's no longer an anomaly. And going 4 trillion, 5 trillion is very possible in the future, especially for Apple, right? We'll continue to break the record. And big tech businesses are still very resilient, right? They have a lot of competitive advantages. It's not easy to displace them, even at this point in time. And that means that if you believe that these trillion-dollar companies will continue to make more trillion dollars in terms of market cap, then this Fang Plus ETN is something that you should look out for. And it is a very convenient way, right? So you don't need to think about what to buy. They need AMD because of the AI hype right now, and you would be able to participate in all these changes, right? And they also dropped Twitter. Twitter was in that Fang Plus in the past, but because it was privatized. If you don't want to bother with this kind of individual changes, those kind of delisting offers, then buying this Fang Plus ETN makes more sense, okay? But I also covered that, you know, know, if you're more diversified exposure to US, QQQ, S&P 500, those are also valid considerations. So most importantly, understand the risk and also your context and your objective, what you're looking for. And I hope that this video have clarified the different instruments and what they are used for. And hopefully you can find something that you like. So lastly, give me a thumbs up for this video, subscribe to the channel, and I'll see you in the next one. Goodbye.